Well, all right. Good morning, everybody. My name's Andrew Pfeiffer with Everhard Advisors. Welcome back to Everhard Advisors University, or welcome for the first time. I'm a wealth advisor out of our Fort Myers, Florida office, and today's topic will be pre-tax versus Roth. We're going to get pretty granular with the information. There is a chat box and a Q&A at the bottom, so if anything pops up and you want to ask a question, feel free. I'll entertain those questions at the end of the presentation. A quick disclaimer, I'm not a CPA or tax advisor. Please consult your own tax advisor when considering the following material. Everyone's situation is unique and nuanced. What may be applicable to some is not applicable to others. So, when I really first start off talking about pre-tax versus Roth and, getting it explained, the end goal is to always lower your lifetime tax bill. And how do you use the tools in your tool belt from pre-tax versus Roth? And, starting off with pre-tax or the traditional method, dollars are being contributed to, an IRA, an individual retirement account, or a 401k or 403b. And as you make those contributions, you're lowering your taxable income. So for the visual learners, as you see, you're going down the turnpike, you're chugging along, making your pre-tax contributions and lowering that taxable income. Well, when you get to the end and you start withdrawing from these accounts, that is when you'll pay the tax. So you're lowering your taxable income up front, but at the end, when you do take distributions from these accounts, whether it's the amount you invested or the growth on those investments, those distributions look like taxable income. The exact opposite is true for Roth. So, as you're chugging along towards retirement, you're putting dollars into a Roth account or a 401k, 403b in Roth manner. You're paying the tax up front. So you're making the decision. I do not want to lower my taxable income. I want to pay the tax now. Then when you get to retirement or 59 and a half and you've had a Roth account established for 5 years, and that's a little rule we'll get back onto is, hey, the account has to be open for 5 years for a Roth, and you have to obtain the age 59 and a half to be able to withdraw it penalty free. But once you get those, requirements and you take the dollars out, whether it's the money you put in or the growth you've experienced over time, those withdrawals are tax free. And, there's different vehicles for retirement savings. First one, an employer plan. So, a lot of individuals joining in today, they're in a 401k or 403b, and they have that retirement plan set aside for them, from their employer. Dollars are coming out of their paycheck. Well, when you're going through enrollment or making a decision on how your contributions get invested, you need to select. Is it going to be pre-tax dollars? Is it going to be Roth dollars? And then also, if there's a match available to you, those are the employer dollars. All the time when I'm on site meeting with participants, I hear someone say, hey, I have a Roth 401k. Not necessarily true. You may have a 401k with Roth dollars in it, but if the matching dollars and the employer dollars are going in, those may be pre-tax. So it's held in one account, and there's just different money sources that they're coded as. But then when we look at a Roth IRA, so an individual retirement account, those dollars are all Roth. And then we're looking at a traditional IRA or traditional individual retirement account. Those are all pre-tax dollars. So just to break it down, the employer dollars, you can have different money sources. It's all one account balance. But when we're looking at Roth and traditional IRAs, those are subset to those money sources. When we're looking at the pre-tax versus Roth plan contributions, those are options you get to make. And if you're making the Roth contribution, again, that is after tax, and the pre-tax traditional contribution, that's tax deductible. So when we're looking at this in the Roth account, investment earnings, those are tax free because once you get to retirement or 59 and a half and you take the dollars out, they're not taxed. Pre-tax, well, it's tax deferred. You're pushing it down the road. And the contribution limits you see here at the bottom of the screen are for 2026. So it's $24,500. And one thing I really want to point out is, there's no income limit for 401k contributions. So no matter how much money you're making, you're able to hit these limits. And then for age 50 and above, there's a catch-up contribution. So you're able to put in 32.5, And the newer rule that's been out for now a few years, but still new, age 60 to 63, and that's the year you turn that age, you're able to put in 35,750 as like the super catch up. But starting in 2026, individuals who earned 150,000 or more in 2025, their catch-up contributions will be coded as Roth. So that's a new rule for this year. Payroll, plan sponsors or your employers are working on that. But if you did earn 150,000 in the year 2025, those catch-up contributions will go in as Roth. And when we look at the federal tax brackets, 10 and 12%, a lot of times we recommend, let's do a Roth contribution. The gray zone is when you're in the 22 to 24, and it's a lot of the individuals I meet with. We're trying to figure out what decision's best for them and their future. And then for the 32% tax bracket and above, pre-tax makes the most sense. Hey, we're trying to lower our taxable income as much as we can. We want to pay the least amount of taxes as possible over time. When we're looking at pre-tax versus Roth IRAs, so a little bit different, there is income limits. So the 401k or 403b, it doesn't matter how much you make, you're able to do Roth or pre-tax. But when we're looking at individual retirement accounts, a participant in an employer plan, if they're married filing jointly, it's 129,000, 149,000 is the window. So if you're over 149,000, you'd be unable to make just a regular traditional pre-tax. And then a non-participant married to a participant would, 242,000 to 252. That'd be the new set window. And then single filers, as you can see the numbers here as well. But if you're a participant in an employer plan, okay, and you're making 242 to 252 married filing jointly, well, that's the phase out if you're even able to contribute to a Roth IRA individually. And the contribution limits, as you'll notice, are a lot lower in individual retirement accounts other than 401k and 403b accounts. 7,500, and then age 50 and a half, there's another catch-up contribution, and that gets up to 8,600. So we're looking at it's okay, how are we taking, our income and investing it, whether it's an individual retirement account or a 401k, and these limits do matter because then you may not be able to, contribute to individual retirement accounts. But in a 401k, those limits do not matter, and the limits do not cross over as well. So depending on your income, an age 52 individual, they might be able to do an $8,600 Roth contribution, but then they would also be able to do the $32,500 in their 401k if their budget allows for that type of savings. So, what is the question to answer? A lot of individuals, will ask the question, do I want to be taxed now or later? That's not necessarily the question I ask. The question I'm trying to ask is, will my tax rate be higher or lower in retirement? So we take a second and think about that. Well, depending on your income in 2026, is that a higher tax bracket than it will be in future when you're retiring? Then you'd want to do a traditional contribution. We're trying to lower taxes. Other side of that, younger individual in their career just starting out, maybe a lower income. So we expect their income to be lower. And as they mature and get close to retirement, they may be in a higher tax bracket. So we would want that individual to do a Roth contribution. Again, will my tax rate be higher or lower in retirement? That's the question we want to help participants and individuals answer in making these decisions. And before we do that, we need to understand the U.S. tax code. So the U.S. tax code, generating income will result in a tax return for the following entities. Everybody will be paying federal government tax. Some individuals will be paying state, and some other individuals will be paying local. So, each person is responsible for filing their own tax return, and understand the system gives you potential to reduce your tax bill, whether that's a 401k, pre-tax contribution or an IRA contribution. Again, let's try to pay the least amount of tax as possible. So calculating taxable income, just the basics, add up all sources of income, wages, salaries, tips, interest from investments, and then we get a subtract. It's called above the line adjustments. That would be like a 401k or 403b traditional contribution that gets to lower your taxable income, student loan interest, etc. There's others out there as well, but just for the basics. And then you get to subtract your itemized or standard deduction. These numbers have increased from last year. The 2026 standard deduction for joint filers is $32,200, and then single is $16,100. And then itemized deductions may include mortgage interest, state and local taxes, charitable donations, educational expenses, and medical expenses. Once taxable income is calculated and the proper tax bracket percentage is applied, you may apply tax credits to lower your next tax bill or your net tax bill as well. Looking at the 2026 federal income tax brackets for single filers, we're going to break this down, starting the top left, 10%. So whether you're making 100,000, 200,000, 500,000, it doesn't matter. Your first 10% for tax bracket wise is up to 12,400. So that number is 1,240. Okay. And then anything above $12,400, so 12,401 starting spot up to 50,400, that is now taxed at the 12% and so on. So when you look at the 22, same thing. Everything up to 12,400 was 10, 12,401 to 50,400 was 12%. Okay, well now, if you're earning 60,000, anything from 50,401 to 60 would be taxed at the 22%. And that's for the single filers. When we look at the tax brackets for the married filing jointly, similar, just close to like a double. So 10% up to 24,800. So your first, tax would be 2,480. Now, when we go to the 12% bracket, 24,801 up to 100,800, that is what would be taxed at the 12%. Calculation would run, okay, you're paying 11,600 tax, and then anything over 100,801 to 211,400, that's taxed at the 22%. And as you can see, as the illustration just grows, when you get up to the 37%, it's just anything over 768,701 would be taxed at 37. What this should illustrate is, okay, where am I today and where will I be going at in the future? That will help us guide us through the decision of, do we make a pre-tax or a Roth contribution? It's very easy when looking at the 10 to 12% rates. Do a Roth contribution. Hey, let's pay the tax. You're in a low tax bracket. But when you go from the 12 to 22, that's a 10% jump compared to 10 to 12 at a 2% jump. Okay, now we're making a little bit more different decision here. We're trying to figure out, is the tax bracket you're in when you're in the 22 or 24 going to be higher or lower than it is now when you're in retirement? And if it's going to be higher now than it is in retirement, well, we want to make a traditional contribution or, a traditional IRA contribution to lower your taxable income so we can pay at a lower rate in the future. Apples to apples comparison, this helps it break down when we start to look at, okay, how does the money get invested or how is it contributed, pre-tax versus Roth, and how does that actually apply to a person's taxes? So income's at 100,000, they make a pre-tax contribution of 10,000. Their taxable income's at 90,000, and they're going to pay a 20% rate on that 90,000. That takes your take-home pay down to 72,000. Well, what if you made a Roth contribution? Same illustration or same demonstration here. At 100,000, your contribution was 10,000, but your taxable income did not decrease. What you can see between the pre-tax is it went down to 90. Roth, you stay at the 100,000. You're electing to pay the tax, in the tax year you make that contribution. So you get taxed at 100,000, and that'd be a $20,000 bill. Your take-home pay is 70,000. And where that 70,000 comes from is 100,000 is your taxable income. You paid 20,000 in tax, and then you made a contribution of 10. So the actual dollars entering your account or your bank account would be 70,000 at the end of the year. Apples to apples comparison, starting off with that annual contribution of 10,000, We have to assume some annual rate of return. Historical average would show you that 10%, depending on how long you're looking for a time horizon towards retirement. So we're going to use 10%, and we're using the tax rate of 20% as well. So we'll start with Roth. $10,000 is contributed. Total tax paid, $2,000. And then each year, year 2, we're going up to 21,000, and that comes from 10% growth on this 10,000, plus then another 10,000 gets you to 21,000. 21,000 with another 10% of growth and another $10,000 contribution gets you up to 33,100. When we're looking at this, we did a 5-year outlook. So the net amount at the end is 61,051. And if you were to take that as a distribution, you would not have any taxes owed. You paid the taxes up front. Pre-tax contribution. You made a $10,000 pre-tax contribution. Taxes saved, $2,000. And if someone were to, okay, I'm making a pre-tax contribution, I'm lowering my taxable income, and I have a higher net pay, $2,000 a year if everything's staying stagnant, that individual takes that $2,000 and goes invested it in like an individual account. It's like a brokerage investment account. So now we look at same calculations here, another 10% added for growth on the 10,000, then another $10,000 contributed at 21, so forth and so on all the way up. Okay. Year 5, your pre-tax account has the same dollar amount as the Roth. However, if you were to take a distribution from the 61,000, your tax bill would be $12,210. Your net amount in that pre-tax really looks like $48,841. With this other investment account that you were taking that $2,000 extra because you wanted to get your take-home pay basically down to 70 to compare it to that Roth individual. They took it, invested it, something proper with it, got the 10% rate of return. That account would have $12,210. What you notice is the numbers are the same. However, they're just taxed differently. And if the individual that was doing the pre-tax contributions that had a higher take-home pay wasn't doing anything additional with that $2,000 they saved from what you see on this slide, and that's where I'm getting that $2,000 between the two, and they were just spending it for everyday needs, well, their account would actually look like $48,841 after distributions and taxes paid if they weren't taking that $2,000 and doing something with it. But what you'll notice is they're pretty similar. So if your tax bill is going to stay the exact same, it does not really matter what you choose. If you do something with the taxes saved, obviously that changes some things and gets you in a better position, so it matches the Roth account. However, if you were to do nothing with that extra $2,000, you'd be obviously lagging compared to the Roth. Now, strategies. There's different ways to implement Roth contributions other than just straight Roth contribution into a 401k or a Roth IRA. One of those is a Roth conversion, and that is when you take pre-tax dollars and actually convert them to Roth dollars. You're allowed to convert, pre-tax monies into Roth. However, in an IRA, this is mostly allowed. Few 401k and 403b plans allow for these in-plan conversions. The amount converted, though, will count towards taxable income. So this isn't a decision you should just make without, spending some time either talking with someone at Everhart, your tax professional, and really looking at the numbers. Because if you convert the amount, let's say in 2026, well, that looks like taxable income. Anything you took from that pre-tax account and converted to Roth, that looks like taxable income. That may jump you into a higher tax bracket. That's the exact opposite of what we're trying to do. We're trying to lower the taxes you're going to pay, not increase them. But depending on life events or where you're at in your career, converting dollars from pre-tax to Roth may make sense because you might try to get all the way up to the actual amount for that tax bracket, such as the 22 or 24%, because you're stuck in there. You just want to convert all the way to the top of that bracket. That's one way to look at it. Then there's backdoor Roth IRA contributions. The big key here is you would open a traditional IRA, but you can't have a traditional IRA already with a balance. You need to have a zero balance traditional IRA. And how this works is you put dollars in to a traditional IRA. So let's say, you're a family married filing jointly and you earn too much to make a straight IRA or Roth contribution. So what you can do is put dollars into a traditional IRA as a non-deductible contribution. So when you go to file taxes, you don't, take that as a deduction, and then you transfer it immediately to a Roth in the same year. And that would be a backdoor Roth contribution. Again, that's when you're funding an IRA that already has a zero balance, you're not taking the deduction, and you're moving it straight to Roth. Funding the traditional IRA, but you cannot take the deduction. Again, that's just the emphasis there. When you're filing taxes, you want to make sure, hey, I made a contribution, it's non-deductible because I converted it right to Roth. That's one way to get dollars into a Roth account if you're above the thresholds for being able to make those contributions. One of the biggest things here is, some people might ask, okay, well, I have a traditional IRA. Maybe it was from an old employer's account that you rolled over to a traditional IRA. And then you think, oh, I can just open a new IRA that's zero balance. No, it's not how it works. If you have a traditional IRA or any traditional IRA that you own has a balance greater than zero, you actually may get taxed twice when doing these conversions and moving them over. So big emphasis there is talk with us, make sure, the decision's educated and not just a rational one trying to get dollars into Roth. Now, when we look at the 10 to 12% tax bracket, similar to my last slide, very keen on Roth 401k contributions or 403b, and then Roth IRA contributions. Pretty easy there. You may want to consider Roth conversions if you have dollars in pre-tax or IRA dollars that you want to convert into a Roth. Roth conversions can potentially cause Medicare premiums to increase if you're over the age of 65. So, let's try to look at that as if you do a Roth conversion, that is taxable income. So when we're looking at, Roth conversions, they could potentially cause Medicare premiums to increase. When you're in the 22 to 24% bracket, that's our gray zone. That's why you'll see Roth and or pre-tax 401k contributions, Roth IRA or backdoor Roth IRA contributions, because if you're unable to put money into an IRA anyway or a Roth, well, let's put it into an IRA and convert it to Roth just so you get dollars invested. So when you pull them out in retirement, you don't have to pay the tax. And then Roth conversions potentially, depending on what, you think the tax bracket may be for you in the future, or, what our government might do to tax brackets might sway someone's opinion because that's an uncertainty. Most people think, hey, we may pay more tax in the future. I'd rather just pay the tax now anyway. Same thing here. Roth conversions can potentially cause that Medicare premium to increase if over the age of 65. Well, when you're in the 32% tax bracket or higher, similar to the 10 and 12, we flip it and just say pre-tax 401k contributions, looking at doing backdoor Roth contributions if you have a zeroed out IRA or you don't have an IRA today, and you're sitting here and you're listening to this presentation, okay, I'm in that bracket. I don't have an IRA because I've been at the same employer for so long. All my dollars in that 401k. Let's set up an IRA and start doing backdoor Roth contributions if you're trying to save more than the 401k limits. And then the hypothetical example I have here, when we're looking at it, Roth is down between that 10 and all the way up to the 22% bracket. That could be someone that's younger, earlier in their career, earning less. Let's make Roth contributions. As income rises, maturity and through their career, you start to get between that 22 and 32% bracket. That's when we're trying to figure out, okay, what's your tax rate going to look like in the future? It's not the decision, hey, do I want to pay tax now or later? It's no, what's your tax rate going to be in the future compared to what it is now? And then when you're over that 32%, that's where the pre-tax contributions come in. And then on the right side of this, Social Security, that's not fully taxed. So that brings you up in that tax bracket. Well, then you have IRA distributions, depending if you're taking it from traditional, well, you have to pay tax on that even in retirement. And then even at age 73 and over, there's something called RMDs, and that's your required minimum distribution from a traditional IRA or a traditional 401k if you're no longer working there. Government basically comes and says, hey, you had all this tax savings in the past, and now that you've obtained the age 73, you have to take distributions from these accounts, and those do look taxable, so they can get the tax revenue on the backside of those contributions you made in previous years. And then miscellaneous items in a 401k. All sources of money are invested based on your investment elections you have on file. Some plans, very few, may allow you to separate how each source is invested. So it kind of goes back to that slide when I talked about vehicles for retirement. In a 401k, all the dollars are joined in together. You have the pre-tax contributions, you have the Roth contribution, and then you have the matching. So instead of having a Roth 401k, well, you have a 401k with a Roth balance. And then even if you're starting a plan today and there's a match and you're doing 100% of your contribution as Roth, the match might be going in as pre-tax. So you have two different money sources working for you in there. But then inside of your plan, you select your investments and they're allocated on the same, investment horizon or risk tolerance that you've put in place for those dollars contributed. The Roth IRA, I love coming back to it. It's a big one. It's the 5-year rule. So for Roth monies to be distributed tax-free in whether it's 401k, 403b, or IRA, it must satisfy a 5-year holding period. And these holding periods are set just for the account. So even if you are an employer, you've been there for well over 5 years making Roth contributions, you retire and you move your money to a Roth IRA, that new 5-year window basically starts, and you need to hold it for 5 years in that account before you can make the distributions and obtain the age of 59 and a half. What we recommend for some individuals is, hey, I have a 401k, it has a lot of dollars in Roth. I want to basically set up a Roth IRA. You can open and establish that account to begin the 5-year window before the transfer of assets down the road in retirement. You also have to obtain that age 59 and a half, pass away, or become disabled for those distributions to be accessible without the 10% penalty. Any questions or communication you want to have after this webinar, we always have our helpline available at 844-GOT401k. And then our help email, that goes directly into my inbox. So, if you make the subject line, pre-tax versus Roth, webinar questions, and you want to set up an individual consultation, or if you want to do, a Teams call or something like that, if you have a partner, spouse, and you want them to join and they're not on this presentation today to start helping you guide you through this decision, more than happy to set off a one-off conversation. And before we dive in to the Q&A as well, the 2026 webinar calendar is up here on the screen. In March, we just did the pre-tax and Roth. Going into April, lessons from market history, insights from past crises as well. And I'll open up the chat now to see if anybody has any questions. So, okay, someone asked, will the recording and slide deck be made available? Yes, we will have the slide deck, or I guess the presentation, the recording will be, put onto our EAU hub online. And you can actually see that down here at everhardadvisors.com/EAU hub. So, if you're sitting here today and you missed January, February's presentation, you will be able to find the recordings through here. And once our presentation's recorded, compliance approved and uploaded, that'll be also found at that same hub. After retirement, is the tax rate based on distribution amount for that year? Okay, so after retirement, is the tax rate based on distribution amount for that year? So how I'm reading this question is, at retirement, I take a distribution from my IRA account. Well, you have Social Security, maybe other part-time wages or something like that. So that's building up your taxable income, and then you take a distribution from your IRA. Just add that on top, and that would be the tax rate you're in. So it's not just the amount you take from the account, it's all of your other earned income, or I guess taxable income, for the year you take the distribution. When doing Roth conversions, does each transaction carry the 5-year requirement? Great question. When you're doing a Roth conversion, think of it as, okay, you're moving money from a traditional to a Roth. If that account has been established for 5 years, that's when the time starts, is when it's open, not when the dollars are being moved into it. So that's why individuals will open the account, have no dollars in it necessarily, but they have the account established for 5 years before retirement, when dollars are going to roll into it. Or if you do the conversion from a traditional IRA to a Roth IRA, or backdoor contributions as well, just getting that Roth IRA open and established for the 5-year window. Oh, great question. Are you allowed to max your company traditional 401k, then do a separate max for an IRA account? Yes, depending on tax brackets, and if your savings allows for that. The limits do not cross over. So if you fully max out your 401k contribution, even if you do have a catch-up contribution as well, and then you want to fund an individual traditional IRA, you can do that. There is crossover between the traditional IRA and the Roth IRA. So the maximum limits there do cross over, but they don't cross over from an employer-sponsored plan and individual accounts. I read something about putting money in your 401k up to your employer match, then try to max out a Roth IRA for that year, then finally go back to the 401k for as much as you can save. Okay, so thoughts on that? Well, I totally agree. If there's a match in your plan, a lot of plans, we work with, they may have like a 5% on 4% match. So an individual goes and puts 5% into their 401k to get the full match. They get the full match, and then, any additional savings they have that year, they may put into a Roth IRA or a traditional IRA. And then if you meet the maximum on that number, they go back to the 401k. I do like that idea. One thing I'll add to that as well is, if you're going to, do the max match for the year, or you're trying to max out your 401k contribution, I highly recommend finding the dollar amount or percentage of your pay that, one, gets the full match, but two, also has you contribute from January all the way through December, just so you don't leave free dollars on the table for the match, and every contribution you make does get the match. So I'm always trying to help participants, if they are trying to max out, figure out that dollar amount, and have that set up per pay, so you actually max out, at the end or towards the middle of December, and not doing it on the front end or something like that. But I do like that idea, just because the limits are higher, and if you do, if you're in certain income brackets, we're able to make those IRA or Roth contributions aside from the 401k. Getting any dollars tucked away into an investment account for retirement's great. I do tend to see some individuals also open an IRA or Roth because they're trying to make the contributions, but then they let it sit in cash. So always want to make sure, your dollars aren't just sitting there not growing for you and just letting inflation eat away at their value over time. Is there a fee for an appointment to discuss what our options are best for us? How long are those appointments? There's no fee associated for setting up a consultation. So I know it's an anonymous attendee who asked that question. Send an email to help@everhardadvisors.com. Subject line, you could just say meet with Andrew Pfeiffer, or Roth versus pre-tax consultation from webinar, something like that, and we'll set those up. A lot of times I ask a few questions beforehand, or provide any documents to help make the conversation more valuable to both sides, such as like a balance sheet or cash flow, depending on old statements and stuff like that to review. because we're here to, review everything. It's not just for 401k oriented. We're here to, help be your financial advisor and financial quarterback. But those can be, 20, 30 minutes like that, just as a quick consultation. And then how can we best prepare for an appointment with you so the appointment is productive as possible? I almost just answered it myself. Quick balance sheet, and I can always provide that before the meeting. Whether you supply that to me before, or if I just give it to you kind of as homework, you do it yourself, and then the conversation can just flow if we're working off of that together. Some individuals, when I go to meet with them, they've seen me, a few times on site when running consultations. They understand it's not just 401k oriented or, retirement plan with the 403b. They start bringing statements and kind of touching on those points like, hey, I have a Roth account. It's sitting here, but maybe it's in cash. And that's a big, aha moment. Like, hey, we need to help you figure out what you're going to do with that account, or how are you making contributions, everything like that. So best way to prepare, get out a pen and paper, or if you're an Excel individual, write everything down, kind of like where your financial life sits. All righty. Chat box has stopped. I appreciate everybody's time this morning. Feel free to reach out. We're here to help in any way we can. Thanks.